Good morning. I'm Afsaneh Beschloss, CEO of the RockCreek Group. I'm delighted to be here this morning with Dr. Alan Greenspan, very well known to our audience for many years as, of course, longest serving chairman of the Federal Reserve, but also extremely well known as the author of a number of books, including History of Capitalism, which we hope Alan will talk a little bit about later. We're also very fortunate that Sebastian Mallaby is in town and could join us today for a discussion. Sebastian has been very kind to advise RockCreek from time to time, but also he is a senior fellow at the Council for Foreign Relations and also writes for the Washington Post and a prolific author and thinker and economist, and many other things. So delighted to have you here, and so glad that we could get both of you in the same room to talk, given everything that is going on. Last time we had this this meeting, we had Liaquat on, and Alan and Liaquat were saying that there is no trade war at that point. It was June 9, in fact. We're at a very different time. At the same time, in the last week or two, we have seen a lot of pieces talked about and written about the 10th anniversary of the financial crisis. And we have a lot of other interesting things going on in the global economy, between the US economy, UK, of course, about which Sebastian has written a lot, and emerging markets. So if I could just start with the 10th year anniversary and where we are today as compared to where we were prior to the crisis. What makes you feel better about what has happened over the last 10 years, and what are you still worried about, Alan?
What we really need to do is to recognize that there really is no non-financial sector and financial sector. It's that difference which is creating a real problem, because we are saying that the financial system needs less capital than the non-financial system. That's where our problem lies. If we had, for example, for financial intermediaries, a equity requirement as a percent of assets somewhere in the area of 30–40%, which incidentally is the average of a goodly part of the so-called non-financial sector, there are very few contagious failures in the, so I would say, non-financial sector. And the reason is that that buffer is sufficient, and has been over the decades, to block any contagion. But what we have found repeatedly, and it climaxed in 2008, I would say in a manner which is going to come back and hit us again, which was essentially that we created a system which had too narrow a buffer. And when you went in, for example, when Lehman, the day before Lehman declared bankruptcy, it had 3% tangible capital. Now you can go through 3% tangible capital in about 10 minutes if you're slowing down. And what we've got to do is to avoid contagious crises. And the only way to do it is to create a big block of equity capital for a financial intermediary.
Financial regulation in the United States remains balkanized. There is supposedly now the FSOC, the Financial Stability Oversight Committee, which is in theory coordinating, but is a fairly weak coordinator. So you still have a lot of non-bank mortgage origination, accounting for more than 50% of new mortgages, which is not supervised by the Fed. And there are all sorts of other intermediaries which don't come under sort of the kind of high-quality supervision that banks are subject to. So my worry now is that, we already have improved the amount of tangible capital in the banks. We've improved their liquidity. But if you were to do more of that, the risk would simply flow into less regulated parts of the system.
China has been a much bigger topic, and depending on the day, markets have got impacted negatively or positively by the news or the tweets of the day. What are your thoughts, Sebastian, on what's happening on this so-called trade war and where we may be headed?
Well, it waxes and wanes, and I think we're actually on a waning path right now. If you take the three areas of dispute, you've got the US versus Europe, which has been de-escalated. You've got the US driving a rethink of NAFTA. The Mexicans have signed on, and I would be very surprised if the Canadians ultimately don't, because they would suffer a lot. I think there are conditions the Canadians want in terms of protecting their domestic cultural industries and farm subsidies, but I think they're going to have to join the NAFTA. So that'll solve that issue. You're left then with the big US-China fight. But at the moment, at least, the idea is there'll be more talks before the second tranche of American sanctions are activated. So we'll see how that goes. So obviously, this is a highly unpredictable White House. The idea that you can reopen everything. I mean, there's, I think, quite a lot of research showing that it's not so much just the level of tariffs that matter for business, it's the certainty of tariffs, and that's what we are sacrificing stupidly.
Interesting. Sort of going back to the US, what has been going on in the US is obviously we've also been growing, not at much better rates than before, nothing like in China, of course, given where we are on our GNP. But employment has been going up by quite a bit the last few years. And we hit the lowest unemployment rates recently in 20 years. But wage growth seems to be still stilted. And it's, we see that some companies are providing benefits, education, health, school, other kinds of benefits, but wages seem to be not going anywhere. Is that going to change, Alan?
Eventually, certainly. The one thing that puzzles me about the most recent 20 years or so is that the inflation rate has been so negligible. One of the aspects that I've learned going back in time in the United States is that the inflation rate defined in terms of gold units, even now, is remarkably stable. And as a consequence, what you realize is that it's not an exactly flat thing, that there's a process by which adjustments are continuously taking place. And I think that's what's going on here. That is, at some point, the inflation rate and nominal wages will be rising at a significant pace. And I am puzzled at the moment as to why it's been so delayed. But that it eventually will occur seems to be inevitable if history is any guide.
Right.
And I'm still waiting.
Should we turn to a different topic? Sebastian has been writing a lot about Brexit. You have been very close to a lot of the decision makers in the UK, Alan. It's really not very clear what's happening just reading what we all read about Brexit and whether it will actually do the good that the original promoters of Brexit thought about. What is your thinking today, Sebastian?
I think to me, there's no doubt that the promoters of Brexit were selling snake oil. I mean, UK growth has already gone from the top of the G7 table to the bottom. There's a lot of anecdotal evidence of financial institutions rebalancing out of London. It's not that they are forcing their London staff to move, but when they add new staff, it's in Paris or Frankfurt or Dublin.
And Unilever.
Unilever, exactly.
Yeah, the news about that.
Not only does the UK have to pay a very large exit tax in the order of $50 billion when it leaves, but also there are going to be these supply chain disruptions to financial services.
Staying sort of on Brexit and Europe, Mr. Draghi last week also said interest rates are not going up, but the economies in Europe are starting to really show great signs of not just life, but some of them are doing really, really well. Does that worry either of you if the pace of interest rates going up there is too slow, or do you feel things are not moving as fast on the economy? So best to be where Mr. Draghi is.
I'm actually concerned about another issue. Is that what Target 2 is? Target 2, for those who don't follow the stuff in some detail, is the mechanism amongst the European central banks, the members of the European Central System, who exchange on a daily basis credits. I mean, the Bundesbank trades with the Banque d'Italia or Banque de France, all day long, and they close the books at a certain time. Well, if you look at the pattern of what's been happening within those lending system, the Bundesbank has become the major dominant lender, and aside from that, it's basically been Luxembourg as the second largest creditor. The rest are all debits with, basically, as you might expect, Spain and Italy being the net debtors. But that flow of credit going from the north, I mean, essentially Germany, to the south in the trade accounts is the same thing. And unless and until we recognize that this is an unstable situation, it can't continue, because at some point, Greece is going to become the prototype of all of the European countries.
We haven't talked about emerging markets. Obviously, what we're seeing, two forces happening. One is technology seems to be a very important way for emerging markets to leapfrog, whether it's in payment systems or in health sector or education or many other ways. At the same time, last year was a great year for emerging markets, but this year I think emerging markets have lost about 1/5 of their value. Every day there is some piece of news, whether it's on Turkey or Argentina, especially, or some other emerging market that has a large amount of dollar-denominated debt. China obviously is sort of on its own, while it's still part of the emerging market indices. It may not be there for much longer as part of that and come out of the index and be its own index. But as we look at these emerging markets, there's sort of two forces. One is long-term forces, where there's obviously more growth, more opportunity, and then there are the other forces that are short-term. Do you see emerging markets sort of coming out of that?
That's the definition of emerging markets.
Yes.
So if they get out of it, they're no longer relevant. We use the term to actually designate a whole series of countries, but it doesn't mean anything by the countries. It means essentially how relative to developed world are they, and by definition you are choosing those who are weaker than some standard which you don't apply to Britain or Germany or the like. And so emerging markets will never be where we'd like them, because when they do, they'd cease to become an emerging market. They've emerged. Emerging is the critical term, and it means something.
Means overshooting in the direction.